Okay.
Assalamualaikum. Today we're going to present ACC 1173 inventories. My name is MAISARAH binti ARSHAD, BDA 2502008.
My name is ALIA BINTI BDA 25022016.
My name is HUMAIRA binti YAZID, BDA 2502030.
My name is AMINAH binti SHABIR AHMAD, BDA 2502020. In this report, it focuses on the application of Malaysian Financial Reporting Standard MFRS 102 inventories, which provided guidance on the recognition, measurements, and disclosure of inventory costs. By analyzing this transaction, the report aims to strengthen the understanding of inventory accounting principle to be applied in real business situation. This knowledge is helpful as it builds confidence for diploma students to prepare accurate financial reporting and improve decision making. Cost of purchase refers to the total cost incurred to acquire inventories and bring them to their present location and condition as defined under MFRS 102 inventories. The cost of purchase of the cement powder is calculated in accordance with MFRS 102. The purchase price of 10,000 kilo of cement powders amount to 45,000 ringgit, which is 10,000 kilos multiple with 4 ringgit 50 cents per kilo. Import duties of 6,000 ringgit and freight in cost of 4,500 ringgit are included because they are directly attributable to bringing the inventory to their present location and condition. A trade discount of 3,000 ringgit is deducted from the purchase cost. So the cost of purchase is 52,500 ringgit. In accordance with MFRS 102, the settlement discount, abnormal wastage, storage costs, and general administrative overheads are excluded from the cost of inventory and are recognized as expenses in the period in which they are incurred, as these costs do not contribute to bringing the inventory to their present location and condition.
Okay, so next I will explain about cost on conversion, which is refers to cost incurred when convert raw materials to finished goods. So let's take a look at this normal capacity, which is 5,000 units, and the actual production is 4,000 units, and fixed overhead is 30,000 ringgit. So absorption rate is basically allocation of fixed production overhead that is based on normal capacity. So our fixed overhead yield 30,000 ringgit over 5,000 units, which is the normal capacity, and we got 6 ringgit per unit. So next we calculate fixed production overhead. So 4,000 units times 6 ringgit, and we got 24,000 ringgit. So for the unabsorbed overhead, we got 6,000, which is will be treated as period cost, which is expenses, and will not be included in inventory. So this transaction focus on how Bright Bill measures and accounts for inventory costs, specifically work in progress and conversion costs, which relates to MFRS 102 inventories. It also requires entities to determine the appropriate allocation of production overheads and exclude any unabsorbed overheads.
Next, I will explain the subsequent measurement of inventory using the lower of cost or net realizable value NRV method under MFRS 102. For every inventory item, we compare its cost with its NRV. Whichever amount is lower will be used as the ending inventory value. The NRV formula is estimated selling price minus the estimated selling cost. For cement powder, the cost is 38,000 and the NRV is 39,800. The cost value is chosen, so no write-down is needed. For wall panels, the cost is 95,400, but the NRV is 92,500. Therefore, the inventory is reduced to 92,500, resulting in a write-down of 2,900. For imported adhesive compounds, the cost is 22,500 and the NRV is 80,100. The NRV value is chosen, so the write-down is 4,400. For the floor tiles, the cost is 31,000 and the NRV is 27,400. Therefore, the inventory is valued at 27,400 with a write-down of 3,600. So the total ending inventory is 176,000 and the total inventory write-down is 10,900. Next, to record this adjustment, the journal entry is debit the cost of sales 10,900 and credit ending inventory 10,900. Cost of sales is debited to increase the expenses while ending inventory is credited to reduce the assets. Ms. Lina should be advised that in accordance with MFRS 102, inventories must be assessed for net realizable value on an individual item basis rather than grouped by category. Grouping is only permissible when items belong to the same product line, share similar purpose or end users, are marketed in the same geographical area, and cannot practically be evaluated separately. Because bright builds inventory includes different types of items such as raw material like cement powder, finished product like wall panels and floor tiles, and imported adhesive from the trading division, they should not be grouped together. Grouping them always allow to increase in value of some items to hide the losses of damaged or impaired item. As a result, the total inventory value in the statement of financial position will be higher than it should be, which does not follow the accounting standard.
Okay, next, I will explain about the recognition of inventories as an expenses. So for the first question, when can we recognize cost of inventories as an expenses? According to MFRS 102, paragraph 34, when inventories are sold, the carrying amount of those inventories must be recognized as an expense in the same period in which the related revenue is recognized. Secondly, any write-down of inventories to net realizable value (NRV) and all losses of inventories must be recognized as an expense in the period the write-down or loss occurs. For the second question, Bright Build sold 500 wall panels to Data Builds in overhead on credit for 110,000 ringgit. Under matching and accrual accounting principles, revenue is recognized when the performance obligation is met and control of the goods transfers to the buyer. In this case, the transfer occurred on 28 November 2025 when the panels were delivered and the title shifted. Hence, revenue of 110,000 ringgit must be recognized in the financial year ended 31st December 2025. Furthermore, the cost of these panels, which is 78,000 ringgit, must be recognized as an expense under cost of goods sold in the financial year ended 31st December. In accordance with MFRS 102 paragraph 34, the carrying number of inventories must be recognized as an expense in the exact same period that the related revenue is acknowledged. Next, for the third question, this is mentioned in the transaction 4. Bright Build retained 200 panels for Mega Retail Sinar Berhad as a consignment agreement. Under this agreement, Mega Retail Sinar Berhad will only pay Bright Build after the panels are sold to the customers. So, under MFRS 102 inventories, goods out on consignment remain the legal property of transferred to the consignee. There will be no revenue recognized and the items cannot be removed from the consignee's book until the agent successfully sells the goods to a third-party customer. Therefore, they must be counted as an asset in the Bright Build's year-end statement of financial position. Hence, yes, these 200 panels must be included in Bright Build Sinar Berhad closing inventory as part of its current assets at 31st December 2025 because Bright Build still has the ownership and control over the inventories.
So, in conclusion, this assignment indicates that the importance of MFRS 102 inventories to ensure accurate and fair view of financial reporting. The case study highlights that only production costs, which is materials, labor, and overheads, are included in inventory valuation, while selling and administrative costs are excluded. It also explains how to treat unabsorbed overheads, value work in progress, and handle consignment goods. Overall, the assignment helps students understand the basic rules of inventory accounting and how they are applied in practice. This knowledge is useful for preparing accurate financial reports and making better business decisions. That's all from us. Thank you.